What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. What is actually happening in the markets? Today, I have two great guests that I highly recommend following on Twitter at Mayhem for Markets and at Aisha Tariq. We will dive into the macro landscape of the markets today. We'll be discussing everything from the upcoming Fed meeting, U.S. equities, crude oil, gold, and we'll also be taking your questions at the end of the show and also throughout the show. We want you to stay engaged, so be sure to put your comments and questions in the YouTube chat. Today's podcast is sponsored by TradeStation and FTSE Russell. Currently, TradeStation is running a promo just for our audience. New users get 50% off brokerage fees for the lifetime of their account using the promo code FUTRAFZT as long as you open an account by June 30th. Go to tradestation.com/Anthony to learn more. Are you watching the stock market, specifically the Russell 2000? The Russell 2000 is a key benchmark for small cap US stocks. Be sure to check out the E-Mini Russell 2000 future symbol RTY and micro E-Mini Russell 2000 future symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. All right, everybody. Adding Aisha and Mayhem. What's up, guys? How are you?
Hi.
Hey, Anthony. Thanks for having us on.
It's great to have you guys on. And, you know, I've been following the two of you, not for too long, but for a little bit of time now. And really just a big fan of what you guys have been putting out there. Straight to the point content, right on, really right on point with a lot of stuff you guys have been discussing this year with the macro side of things. So today I just really wanted to, get together with you guys and have a discussion about what's really happening in the markets right now. And I know both of you guys have slides, which is great. And so if you're listening to this later on audio, you got to go over to YouTube to see the slides. And I think maybe we'll start with you, Aisha, because you're right next to me here in the middle. And talk to us a little bit about some of the things that you're seeing in the macro landscape right now.
Okay, this is very interesting because I thought we were going to let Mayhem go first.
Well, Mayhem, we'll go
okay?
first with you. Let's go.
Okay.
We switch it up.
Let's do
Mayhem,
that.
let's go first.
All right. So here I am. And so the first slide that I have, we're looking at just sort of rotations that are happening underneath the market. And I think it's kind of important to look at this because one of the things that happens that can give us a clue as to where institutional positioning is going is kind of where these flows are and where the relative strength is. So we can see since December of 2021, low volatility enjoyed a pretty nice outsized bid versus high beta. That's starting to reverse a little bit here though. So it's starting to show that there is some risk appetite coming back into markets of late. So I think that's noteworthy. It's certainly worth paying attention to given the environment that we're in right now, where we are starting to see a bounce, that we do see some, more risk taking by institutions. And essentially the low volatility stuff is the more defensive end cycle plays, and the high beta stuff is more the late to mid cycle cyclicals and other types of stocks. So it just kind of gives us a sense that maybe there's a little room left for at least this counter trend rally to continue.
I want to talk about something real quick before we go on to the next slide. And, I was talking to a few of my friends about this year. I said, what's different for me on this bear market versus a lot of the ones I've traded in the past is that it is low volatility. I'm seeing it where it's almost like, I think I talked about this with Pax, and we said something like, it's like a reverse bull market where we're just grinding lower.
Right.
And it just makes it so much more difficult because we have all been trained, at least over the last, I would say probably since 2008 type bear markets, they're really fast, right? And you look for the V bottom, and in your mind, you keep thinking to yourself, that's how it's going to end. And maybe it doesn't this time. I'm just curious, in your experience, what do you think about that low volatility that we're seeing, and why do you think that is happening?
I think low volatility is in part a factor of a very well hedged market. So when when volatility is as it's measured, in 30s. It's pretty high, just relatively speaking, but you also have a pretty steep skew towards put premium on the S&P volatility surface, and that's something we'll get to in a subsequent slide. I actually have some good stuff to cover on this, but
Great.
in summation, it's really when you have a very well hedged market, it's harder to kind of have those crashy types of drawdowns.
Yeah, no, great. I totally agree with you. I mean, it's one of those things where it's well hedged because a lot of people see this coming, and yet it's still happening.
Right,
Yeah.
right.
Okay, well, we'll see what you got for the next slides.
Sure. So next we have S&P value versus growth, and this is another area where you saw pretty significant outperformance from December of 2021 through the present, although growth is starting to catch a little bit versus value, but value is still enjoying a pretty strong relative strength uptrend versus growth. So, value tends to come in favor later cycle. This is no difference in this case, and I think it makes sense because there's a lot of the same sort of industrials, materials, energy stocks, and other kinds of parts of the value factor that are outperforming where we are at present. So it just kind of shows you where we are underneath the surface. You have rotation short term from low volatility to high beta, but also some rotation short term from value to growth. So there's more risk appetite short term here.
Yeah. Aisha, I mean, I know we're going to get to your slides, but I just wanted to see if you want to chime in at all and see, just maybe comment on any of the things that you've seen Mayhem talk about so far.
No, I'm good. I mean, he's right. What we're looking at is like late cycle plays. People are moving more into value stocks versus high beta, which makes complete sense because the market is volatile. We have rates going up, and that's what happens to valuations, right? People or companies that don't have cash flows tend to suffer. So it's exactly playing out exactly as we expected it to.
That's the one thing I will say about this, and that's why, I'm glad to have both of you here, is that you guys have really been doing an outstanding job, really just laying out the macro landscape a lot of this year as I've been following you. And what I find so interesting about this year is that you, along with some other people I've spoken with, people really have seen a lot of this coming, and things are playing out to where it's different in the past where, you would say if a lot of people think this is what's going to happen, that's not what's going to happen. But that's actually not the case this year. Is that
That's
Right.
not
strange?
true.
Yeah.
Yeah.
It's a weird year, and it's hard as a trader because we want to doubt that everybody's probably wrong, but it turns out that they've been right, and it still makes it challenging to execute. I don't know, it's just one of those things where I think we get this in the back of our heads, and it's just, I think it's just an interesting year to say the least.
It is, no doubt about it. No doubt about it. And this is a good representation of what's going on in this. This is a chart that is various bond and note proxies, ETFs. And so you've got in red TLT, in black IEF, which is the 7 to 10 year Treasury, 1 to 3 year Treasury in green, corporate high yield in purple, investment grade corporate in orange, and then mortgage-backed security ETF in gold. And you just can see there's just this sort of globally harmonized deleveraging, and this is just one representation of it in bonds. And this is what's happening as rates are rising across the board. So, the market has been doing some of the Fed's work for them, is what you could reasonably say with a chart like this.
Yeah, no, that's very interesting just to see in how much stuff is moving like that in unison like that.
Absolutely. This is commodities versus the S&P 500, which have basically outperformed the index by almost 100% since December. And I think that's pretty significant. We've seen that commodities are just another bit of evidence that we are very late cycle to end cycle. They typically ramp as we get closer to the economy kind of overheating. And we've also got other catalysts in this on the supply chain and production side. But I think it's also very interesting because it just means that commodities versus the S&P could still have some room to run here.
It's really just been the year of commodities, which is obviously great for futures traders. But when you look at the commodities versus the S&P 500, and I don't follow all the commodities, I'm just curious, what are the main ones that are in there? Because obviously what stands out the most, and I'm sure we'll talk a little bit more about, crude oil and natural gas. But is that how weighted is that, the commodities versus the S&P in that chart?
It's equal.
Equal. So it's really, do you know what it spans from like basically softs all the way through?
Yeah, so it's the S&P Goldman Sachs Commodity Index.
Got it.
And so it's I'm pretty sure it's well weighted into oil, but it has exposure across all the commodity complex.
Got it. Thank you.
Yeah. So the last chart that I wanted to show before I handed over to Aisha to talk about oil was gold, and gold is it's interesting here. And the reason that it's interesting is because you've got this huge demand zone right here. We're well above it. We're also above, but testing this 50-week moving average. To me, when I look at gold, I do want to see that convergence. I want to see us above, a big area of demand if I'm looking to get constructive. But I really also find the 50-week moving average to be really important to quantify whether we're in an uptrend or not. So you could say cautiously, maybe it's time to start looking at gold miners, because maybe rates have overshot just a little bit short term. Maybe the dollar is overshot just a little bit short term, and maybe the yellow metal has a little bit of room to bounce in that environment.
I actually, Aisha, if you don't mind, I'd like to. I know we're going to get to your slides here in a second, but I want to spend a little bit more time on gold because this to me it's been the most frustrating market for me this year.
Sure.
Playing it to the long side, I feel like it's just been so difficult.
Yeah.
I mean, I'm not a macro person like you guys, but I could tell you from a technical basis, you could just see it from the chart you have there. I actually make it bigger for everyone to see it. Uh, it's a year where it's like I look at it like this, and you guys, just curious what you think. If it's not working now, I don't see when it's going to ever work.
Well, I think the main thing about gold is it does, like, markets are already kind of engineered to divide as many people from their money as they can as often as they can. Gold's just optimized that to the next level. So, like, almost everyone loses on gold, shorts and longs. It's a really difficult market. And I think if it wasn't for Ukraine, it might look a little different because I think we got some of that demand front loaded into that. And when we had that blow off again, the market didn't look quite as constructive. It's really hard to get the bid back after that.
Aisha, what do you think about gold?
Well, surprisingly, I think gold should be much higher. For the simple fact that I think its time has come. Um, Gold has historically always been a metal that has been underappreciated, I think, for the last decade or so. There's been a lack of investments in gold, there have been a lack of investments in mining. But I think over the last 2, 3 years, there's been some progress to that effect. So I think we're going to see a little bit of that come in. So I'm talking about from the supply side. But then, as well, from the demand side, as Mayhem said, that some of that has been sort of, the relief trade. People are scared. People don't want to put their money in stocks. They don't want to put their money in bonds. They don't want to put their money in crypto. So they decide to put their money in gold. Whatever you say, gold still remains the metal, or the commodity that is the safe haven, right? So as soon as the war broke out, we saw gold go through the roof, and I think this cycle is going to play out over and over again. I mean, the way it's set up, I think gold should cross 2000. When is anyone's guess, but I think we'll see this in the next year or two. Gold should cross 2000.
You know, and I don't disagree with you. And we'll get to your slides here in a second as we just continue this kind of chat about gold. It's just managing the risk side of it is just that's what's so difficult. When you see traders, we always talk about that. Managing the risk. Is there anything when you look at gold and you think that it will get to above 2,000? How do you play that? I mean, do you think it's options? Or is it you waiting for maybe another headline or something? Maybe it's a step in. Like how do we play that as traders? Because it's so hard when we don't know. Really, like we said, it's been so frustrating of a year that it's just hard. I think it's just so hard to be in it.
Ma'am, you want to go with the trading?
Sure. For the trading side of gold, I would say I've been favoring both playing the futures contract short term. I don't really like staying in gold very long term because you can see in the chart why. And I also like looking at call spreads because you do have pretty good front loaded volatility in GLD and in the gold futures contracts, and so you can sometimes exploit that convexity by basically setting up a calendar call spread, sell some of that near dated premium to lower your debit on buying some longer dated premium. So that's another way. And then if it doesn't work out with your timing, you can keep rolling.
Yeah, I like that. That's because that keeps you in the trade. It keeps you in a stronger hand in the trade. Uh, Aisha, I know that you aren't the technical person, but let's just say on the macro side of things, what would make you change your mind that gold is going to get above 2,000?
Changed my mind. I think everything is in play already for gold to go above 2000. So it's not really something that would sort of change my mind. I think I would say that we are more in an iffy space or a consolidating space, if you'd like to use technical terms. But I think it's only a matter of time. And if you ask me, I'm pretty much looking at miners. I think there are a few strong miners like Franco Nevada, like Barrick Gold. You have ETFs which you can play. So there are various ways to play it. And of course, as Mayhem said, you can play it on the technical side. You can play taking futures or options. I don't play gold options, but just
Yeah.
futures and maybe miners. Yeah.
Yeah, I think the miners is a great point because the miners, it's just a lower volatility trade, and
Mhm.
if gold is going to perform, the miners are going to perform. I think, Mayhem, right? Like we always want the action. We want the one that's going to probably pay us the most. So we always look at the futures. And obviously, I'm a very pro futures kind of guy. But when you want to be in a market like that, I always say it's not bad to take a look at the miners as well. Just another way
Absolutely.
to go about it. So Aisha, I've got your slides up here. If you want to go
Yes.
through, and then we'll see
No, thank
more of
you.
the
But
conversation.
you know what? I didn't have any slides on oil. So if it's okay, I'm just going to talk about it.
Oh yeah, no problem. So you want to talk about crude oil first?
Sure. I mean,
Okay, sure.
let's just discuss what we're seeing right now with oil going through the roof. I think what we're seeing is a confluence of factors again. We're looking at China opening up, which is probably pushing up demand. We're looking at OPEC still not producing enough. And of course, we have the issues in the US. So, look, when we were looking at oil about 3 months ago, and I actually did a chat about oil 3 months ago, we were pretty sure that oil was going to cross $150 a barrel, but that didn't happen. And one of the reasons it didn't happen was because Biden decided that he would release crude oil from the strategic reserves, right? But I think that's just like a band aid to the problem, right? I think we need a lot more than that for oil to be stable and for oil prices to come down. Now, having said that, I think most of the oil producing nations would rather have oil at a higher price because it just helps them make more profits. So you have sort of an imbalance of, let's say, ideas here. On the one hand, you'd want prices to be low so that the consumer is not hurt. But on the other hand, the suppliers themselves would like it to be on the higher side so that it makes more sense for them to pump oil because it is expensive to get the oil out of the ground. And the only way that we can do that is to actually have higher oil prices. If you look back over the last 10, 12, 15 years, even, there's been very little investment in oil compared to what it should have been. And right now, this is why we're struggling. Um, the OPEC countries have what it takes to pump more, but they're not going to. And not to the extent to lower the price of oil below $70 a barrel. So I think over the next 1 or 2 years, we will continue to see oil somewhere in the 120 range, if not more. This is for WTI, of course.
Yeah.
Uh, if you look at, so, and even in fact, a couple of days ago, Jeff Curry from Goldman Sachs came out and said that he's predicting Brent to be at 135. So that puts WTI somewhere around the $130 barrel per barrel mark. So we have. I don't think oil prices are coming down drastically anytime soon. This is my view.
And when you look at it from a trader's perspective, the technical side of things, that there's no stronger chart out there. For me, I trade in and out of oil all the time. I'm only trading it to the long side. I love when you have fundamentals coinciding with technicals. right, Mayhem? When you've got both working together, that's the sweet spot.
Absolutely.
And what's interesting about oil to me is that we're in a place where it's having it's we're at a price where it's just impacting just everybody, right? It always impacts everybody, but when it gets higher, it has the impact that we all see and talk about. How big of a concern do you see, because oil is going to stay high, that that's going to affect, obviously, the consumer and potentially the stock market?
So, we're seeing what it's doing to the consumer, and we're seeing where inflation is. And I think this is one of the biggest reasons that inflation remains sticky to the upside. And because of this, we're going to see a lot of pressure from the Fed, right? So their target is to lower inflation as quickly as possible. And if oil prices don't come down, I don't think we're seeing inflation coming down to the 2% level anytime soon. And this is exactly the problem that we're in right now. The Fed will do what it takes, and they have only a limited number or a limited set of policies that can actually influence inflation, but they can't influence the price of oil. So we're sort of in a catch 22 right now. I mean, we need one or the other to, move. And it's just, we are definitely going to see a lot of pressure on the stock market continue. I don't think, I mean, you were saying that we're having a slow grinding bear market. I think this is going to continue for a while.
Mayhem, I want to talk. I'll bring you in here a little bit and just get your
Sure.
thoughts on it, because I mean, so many of us we're so focused on the Fed and with the interest rates, and at the same time, you've got oil today at 122. And this, I think earlier when you and I were chatting, I said, well, equities actually bounced today with the treasuries. That the 10 year is still staying right around 3%. I don't know where it is right now, but yet oil's making new highs, and I think that everyone's so probably focused on the 10 year, at least on the trading side for now, that oil is keeps going up. I mean, do you think that at some point this becomes more of a focus?
Yeah, I mean, well, first, I want to echo what Aisha said because I agree with her point of view 100% that, we're in a situation where there's just not enough production of oil. Demand is starting to normalize. You've got, summer travel season coming on too. So there's a lot of catalyst short term and intermediate term for at least stability, if not upward pressure to prices. And I think it matters because the pass through effects still haven't been fully realized to all of this. And the stickiness of prices matters too because the Fed doesn't particularly concern themselves as much with that as they do with the velocity of price movement. So we could get to a situation where PCE is 3-4%, but consumers are still sort of struggling because the prices of what they're buying at the store, the gas station, the utility bills, all those things aren't coming down. So there's sort of a confluence of factors that promotes the idea of not only a long duration bear market, but also further compression of the elasticity of consumer budgets. I mean, it's just that no one's really in a great spot right now. So I think we do have room for further weakness, and I don't think we've seen the worst of this yet. And to say that we have is a little bit much because the Fed hasn't even effectuated QT yet.
Yeah, I know we still want to get to your slides, Aisha. I want to say just one last thing before we get there. I'm seeing a lot of people saying that inflation's already peaked. We'll go to you, Aisha, first. What do you think about that? Has it?
So look, maybe it has, maybe it hasn't. But the point is, I think the rate of change of inflation may be coming down slightly, but inflation still remains upward sticky. So look, I had a slide, and maybe we could, I could show that,
Yeah, let's pull that
and
up.
that would yeah. So that would sort of give you some idea. So this was an unemployment slide, and this is what I wanted to show you. So
Okay.
this is the last CPI for food. Food is at 10.8% year on year. I mean, that is massive. And this is after inflation came down just by a wee bit. It's not enough. So we can go from 8.2 to 8 point or 8%, but and the rate of change may be coming down, but at some point we needed to come down far more and far more drastically, right? The problem is exactly what Mayhem said, that these prices, once they go up, it's very hard for people to lower prices. So you go to the store, you buy something for $10 now because the price used to be 5, now it's 10. How much will they bring it down? 8? People, so it's always, inflation always remains upward sticky, and this is a problem.
Mayhem, chime in on this a little bit here.
Sure.
That's such a great point because you think about it. If you raise the price of something because there is inflation and it's costing you more, then inflation comes down. Do you really lower the prices if you're the one selling it, if you're still selling them?
Well, I mean, if you have pricing power, I don't think you do, right? I
Yeah.
mean, if you're able to continue selling at that price and people are content to continue buying or at least don't have a choice, then why would you lower prices? And we saw this in 2008 too. We had a combination of inflation and shrinkflation. And shrinkflation is fun because you go to the store, you pay the same and you get less, and you get actually like a smaller container of whatever it is. Like you buy a bag of chips and it's the same amount of air in the bag, but there's less chips, just as an example. So that's one of the things that I think it is going to be a sticky problem. Absolutely, I agree with what Aisha's saying because one of the things also is that I don't really think that the input costs are going to go much lower anytime soon either. Whether you're talking about crops, whether you're talking about energy, whether you're talking about fertilizer, and fertilizer costs have already outstripped the increase in price and crop costs, suggesting that pass-through could continue to push prices higher.
Yeah, I mean, this is the scenario that we're faced with. I mean, this is not something from when you talk about what oil and inflation that you just turn a switch and this goes away.
Right.
It's just not the case. And with everything that you guys are showing us, it just the proof is there. Aisha, what else would you like to show us on your slides?
Yeah, so no, so following on from that, I think what happens next is wages start to go up, right? So when people can't afford to buy things, they ask for more money, right? They want higher salaries. So companies can do one of two things. They can either raise prices or they can cut costs. And I think somewhere along the line they will have to strike a balance, right? So you might have some pricing power to raise prices, but at the same time, I think costs are the first thing that you need to cut. And when you cut costs, I think the first thing you cut are people. Unfortunately, this is how the world works, and this is going to bring us to a problem of unemployment. So most people keep saying that the Fed is going to pivot very soon because of a number of factors. You can say stock market or whatever, but I personally don't think the Fed is ready to pivot anytime soon. If you look back to the 70s or to the 80s, you can see where inflation used to be. So this is, I don't know if you can see the number, but in 1982, yeah, in 1982, the unemployment rate was 10.8%. And this
Yep.
is the time of Volcker, right? He had to control inflation. And so what he did was, regardless of whether unemployment was going up, he kept raising rates. We all know the story. And I don't think Powell is going to do anything different. I think he's confirmed now. He's ready to pull the trigger. He will continue with QT and he will continue raising rates until inflation comes under control. And I think that's going to be a while. So all this talk about the Fed put and the Fed stopping because the stock market starts tanking, I don't think that's a scenario we're going to see play out anytime soon. I think they will tighten into a recession. I think they will not backstop the stock market.
Man, I'm just curious. I'd like to hear your thoughts on what she just said.
Yeah, absolutely. So, I mean, I agree. I think the Fed is in an unenviable position right now. They've got political pressure from both parties to try to fight inflation. They've got a limited set of tools, like Aisha touched on. And really, what they can do is they can effectuate demand destruction. And that's great and all, but it doesn't resolve the supply chain issues. It doesn't resolve the production issues. And so, what it really does is it just sort of forestalls revisiting those issues, right? They can raise the cost of capital, which is a great way to kind of take off excess demand from the economy, so it can alleviate some of that pressure potentially. But I agree with Aisha, it's going to take a while, and it's probably more that the velocity of inflation comes down rather than that upward stickiness of prices. So I think that that we could be in this situation for some time to come, and I think also that people are underestimating the impact of QT, because quantitative easing was the sort of lifeblood of upward price discovery in markets for the last better part of over 13 years, right? On and off, on and off, but every time the spigot was on, the risk assets were able to continue to climb higher. And so the other side of that is, when you turn the spigot off and you start draining the pool, well, those same risk assets have to come down.
Yep.
No, exactly. All right, we're about halfway through, everybody. I want everybody to stay engaged. Put your comments and questions in. We're going to take a 15-second break. We'll come back with more slides from Aisha and Mayhem. All right, we are back. We are now looking at some slides. This is actually the same slide, Aisha. Well, what
Yes.
else do you have on here that you'd like to discuss?
Um, is Mayhem still there?
I'm
Yeah,
here.
he's there.
Okay, so did you have anything you wanted to show?
Yeah, sure. If you'd like, I could talk a little bit about what I'm going to call mid-June madness.
You want me
Which
to
I-
pull up your slides?
Yeah. If you don't mind, I just want to go through a couple real quick here. This is some
Cool.
stuff that I think is pretty interesting. So, for folks out there that haven't really looked at all the calendars in June, there's this sort of convergence of very interesting events starting to come up next week, actually. And in that week, we've got the beginning of quantitative tightening. As you can see on the chart on screen, that's going to be $14.9 billion of Treasury securities rolling off the Fed balance sheet. And then, of course, as we get to later June, you've got another over $30 billion rolling off. So that's material. Now, the other side of that, there's a little bit of a countervailing force because Treasury debt issuance is coming down. The Build Back Better bill and other kinds of COVID stimulus never passed. So there's not as much in the pipeline. So it kind of little bit offsets the initial QT, but as it gets going more and more, it will have a greater impact. So it's something certainly worth keeping an eye on. And the reason the Fed is able to do QT as a sort of passive roll-off, they're not selling treasuries, they're actually just letting them, basically mature, is because the majority of their exposure to treasuries rolls off in the next 2 years. And so they have the optionality to do this and all they have to do is just not step up as a large indirect bidder at these treasury auctions. So, they're basically, they're going to be selling their mortgage-backed securities, but on the Treasury side, they can just keep kind of rolling them off the balance sheet, right? And it's a big balance sheet. It's a really big balance sheet, actually. It's so big that it's a third of the size of U.S. GDP. So that's one of the reasons the Fed's probably looking at this and saying, well, geez, asset valuations are really high. Our balance sheet is ridiculously huge. What ammo do we have for the next crisis? And I think that's one of the motivating factors for sort of what they're doing here, right? So the other thing that's happening in June, of course, is it's not just QT. We actually have a pretty big triple witching that's going to be going on. It's going to be $3.2 trillion of notional options gamma expiring, with $1.7 trillion of S&P index options in the morning and $560 billion of single stock options in the PM settlement. So that's really going to be a nice little driver of volatility during already a period of time where you've got the beginning of QT happening. You've also got volatility product expiration the same day, 15th. That's also the Fed meeting. We also have Vanna flows going on pause. You have the cessation of the current beginning of month flows. And this is also a very weak month historically in a midterm year. So it's a sort of confluence of things that are going on. I want to talk about the Vanna flows just real quick here. This is the volatility surface of the S&P 500. It's steeply skewed towards put premium, which just means, as we were talking about before, institutions are really, really, really well hedged. So you get this sort of stair step down rather than this sort of, just falling down an elevator shaft kind of decline in the markets in this type of environment. So that's one of the things to kind of keep in mind. But as we get to mid-June, those supportive flows stop. and they stop until close to the end of the month. So it is a window of opportunity for more volatility to take place. And then finally, this is just June is very historically weak in a midterm year. I think it is something that's kind of worth considering, keeping in the back of our minds. Past isn't prologue, but certainly this is something that we've seen observed since 1950 to the present.
Aisha, you want to comment on any of the things that he just went over there?
No, it's just very interesting. I think we're going to have a glorious time next week.
I was going to say, the 15th is, so you have that, you said it was options expiration. Obviously, we know we have the Fed meeting. And what's really interesting about having an options expiration, I'm not an options guy, so it's definitely not my forte, but I will tell you this, that going back to what you had said, Mayhem, you said there's so many people that are this is a hedged move, right? Because everybody is anticipating a lot of what's happening this year. A lot of the moves that I see, you can go back and see how many people on Twitter said, I think we're due for a bounce now and the market's slowly grinding up. A lot of people were bearish when we were going down. What happens from your experience when you see an options expiration on a really very major day like the Fed meeting? Just wonder what kind of volatility that even opens up for a day like that.
Sure. So it's going to be on the Fed meeting. We're going to have VIX-piration. That's the volatility product expiration. And then the options expiration will be triple witching. So it'll be stock index and stock index, and futures options. That or futures contracts, that is going to be the big driver on Friday. That's where that 3.2 trillion of notional gamma rolls off. So the whole week is going to be much more, shall we say, interesting. I think there's much more room for wider ranges of price discovery. I don't know that the current positioning necessarily favors bulls or bears. I think it's going to be more determined by the technicals that we go into the week with, what the Fed ultimately does. But I think we are poised, if we do have a negative event catalyst, for significant downside. And if we do have a positive event catalyst, the other way, because we already have basically a market environment. There's this leptokurtic distribution of left and right tail risk. And what that really means is there's low liquidity across the board. And that means that it takes less volume to move prices, and you have much more options-driven participation, which implies leverage. So it's a market where really, a smaller group of participants in this type of environment can move prices wildly. And once one takes control of price directionality during a day, typically it goes very well in their favor. And then add to that, we're in negative gamma territory, right? So that means dealers are in a chase environment. So for every 1% up in the S&P, they're buying something like $15 billion of ES futures. For every 1% down, it's the opposite in terms of what they're selling. And that's just sort of how they're hedging delta in this environment. So it creates an environment that exacerbates that volatility in whatever direction as well.
Expand on that negative gamma. I'm sure there's a lot of traders out there listening to this that are kind of scratching their head saying, I don't completely understand that.
Yeah, so basically it has to do with how dealers are hedging delta. There's a great book by Squeeze Metrics on this. It's a free PDF that maybe we could link in the show notes. It gets into this in the nitty gritty. But in essence, Yeah, but in essence, it is something that we have to factor in because we've got over $1 trillion of volume trading in index options and ETF options every day. So it's a huge, huge driver of price discovery. And a lot of that is actually on the put side, not the call side. It's a lot of these hedging flows. So as the hedging flows are happening in real time, it's actually pulling liquidity out of the market. And as those dealers are seeing those hedges lose implied volatility and get decayed from theta, they're actually taking off those short positions because they don't have to, because the delta has dropped. So it's something that I think we have to keep an eye on. In negative gamma territory, essentially what it does is it causes rips to be bought and dips to be sold. So it's adding to volatility. If we get into positive gamma territory, it's the opposite. Rips get sold, dips get bought, so it compresses volatility. So it's kind of just important to keep track of what's going on in terms of options positioning, in terms of where we are, on SPX gamma, just because it can give us an idea of what kind of trading environment we're getting into, especially if we're trading, stocks or equity futures.
Can you tell people how they would identify when we go from negative to positive or positive to negative? What is something that they look for to identify that?
So you probably need to have an analytical tool. Sergey on Twitter wrote something like this. It's a free Python script you can download. There's also services like Spot Gamma that have that kind of information available at a premium. And I don't think it's available anywhere quite for free unless you're doing some of your own work, like with that tool. And remember, the other thing about options is every model we look at is to some degree naive. So it doesn't see everything. So there's a lot of dealer positioning and kind of implied positions that may or may not exist or may not be what we think when we just look at all the CBOE data. There's a lot of things that are happening outside the CBOE. So even when we think we know exactly where these levels are, there is some nuance to it. It's not exactly always what it appears to be.
Got it. No, thank you for sharing that with us. Like I said, that options world is not really my my strong suit. Although I do trade them sometimes, but I really just trade them. If I'm bullish, I'll buy calls or I'll sell puts, things like that. But I'm just trading directionally. I definitely don't know the in depths of it, but it's very interesting hearing you talk about that because, once again, a lot of what we're talking about today is what's actually happening in the markets, and the option side of things. They're always important. Let's face it, they're always been important. They always will be a very important aspect of the market. But this year, from what I'm getting from you, they're even more important. They have so much more of an impact on what's happening in the markets.
Yeah, I would say so, and I would say really from the second quarter of 2020 all the way through. And when we're talking about the second quarter of 2020 all the way through, say, the last quarter of 2021 up to November, you're saying on the single stock side, or you're seeing on the single stock side, I should say, the most call premium ever bought. February of 2021 and November of 2021 were historic, and then in November the most equity put premium sold at the same time. So people got so ridiculously bullish. It was a giant red flag. And yeah, so that retail flow in options, that was a big thing while the party was on, right? While liquidity was abundant. That's since dried up. A lot of people have gotten blown up. A lot of retail's exited even their equity positions as well. But on the other side of it, the index-based trading and the ETF-based trading of options has ballooned on the institutional side. And that's a lot of those hedging flows that we're talking about.
Aisha, what are your thoughts on some of the things he was talking about with the options markets?
Um, I don't think I can say anything more to that. He explains it so well.
He does.
And while I do understand these things, I don't think I could ever explain it the way he does. But no, I think I'm pretty much like you, just plain vanilla stuff, and that's about it. Maybe spreads here and there. But you're right. I mean, the options market actually does have a big impact, and it's something that I think we all need to follow and try to understand, even if we can't explain it. Um, yeah, that's about it.
Yeah, no, it's one of those things where it's one of the things, Mayhem, where I've been following you a lot on Trader Aid, and I think it's really interesting. Like it's opened my eyes to options more and more. I don't necessarily think I'll be trading any sort of complex options anytime soon, but I think it's extremely important to understand,
Yeah.
um, how they work. We're actually starting to get some questions in, and actually, let me see this question right here. So this is actually from Bar Chart. They said, "What's the best way for investors to get yield to preserve as much purchasing power as possible?" Aisha, I don't know if you want to take this one or Mayhem.
I'm not sure I understand the question.
I didn't either, really, to be perfectly honest. I was like, I don't know. It says it's. I'll repeat it. What's the best way
Does
for
he
investors to get yield to preserve as much purchasing power as
I mean, are we
possible?
talking about like getting fixed income exposure?
maybe
Because I guess,
yeah, or dividend yield?
Yeah, I think because we're talking obviously about the option side of things, like, what is the best way to get the most out of maybe a potentially trade with preserving your purchasing power. I
I,
think that's one of the big things when you look at the options market. A lot of time I'll go to it. Like right now, I'm actually long. I'm long some calls in the Nasdaq because um, not necessarily for this reason, but I look at it as it's a less expensive way for me to participate with taking some of the volatility out. I have a very small Nasdaq call position on right now, and my purchasing power is still pretty big if I want to do something. So I don't know if they're maybe talking about that when it comes to the option side of things, because it allows you to kind of what we discussed today, having a stronger hand in the market without getting weeded out. And if something that you really like comes up, you have the purchasing power to potentially step on it a little bit.
Yeah, so I mean, if it's options, I would say one thing: if you have commons in your portfolio and you're looking at a sideways to down market, but you want to hold those, you can always look at selling calls against those to harvest some premium that way. That can be kind of like a way of generating a dividend on top of whatever you have, or at least looking at it reducing cost basis for those shares. On the other side of it, looking at yield, I would be careful just because we're in this environment of tightening liquidity, and it seems like that's going to go on for some time. So a lot of things that are rate based, they could take a little breather here. We could see rates go down, short term, but longer term with what the Fed's doing, it looks like rates are going to go up, which means the principal price of what you buy is likely to go down. There are treasury bonds though that I think are like it's like a small offering. They offer to families, and I think they give you an 8% yield on those. They're pretty safe, so that might be something to consider as a part of gaining some protection against inflation. In terms of getting a really safe yield that protects your purchasing power.
Yeah, this is another thing that Deer Point Macro put out. He says, I think Volcker was a bit of a fallacy. I'd refer to Friedman's piece on this. However, we are seeing big deflationary forces in swap spreads, Eurodollar futures, and XCCY premium. Either
Cross
of you want to
currency
comment on that?
premium.
I don't know what XCCY premium is personally.
Cross currency premium.
Got it.
I mean, I don't think Volcker was a fallacy. I think he did what he set out to do, and he did a good job of it. And he pretty much said consequences be damned. There were protests in D.C. Farmers drove their tractors up there because the cost of finance got so high they couldn't afford their farms anymore. And he did slay inflation. So I would say it's not a fallacy personally. What do you think, Aisha?
He did what he had to do, and I think you're right. He did a very good job. And while we are seeing certain deflationary forces, I still think I defer to what Mayhem said earlier that we are still seeing supply chain pressures. We are still seeing prices being upward sticky. We will also get some pressure from wages, so there'll be a bit of a wage spiral. So maybe in the long run we see deflationary, or right now what we're seeing is disinflationary pressures, not deflationary. Deflationary pressures will take 5, maybe 7 years, but the disinflation is not enough to bring the level of inflation down as quickly as we think it's going to. I think this is going to play out over the next 12 to 18 months at least.
And Anthony, one of the things that has been said is the cure for high prices is often high prices.
Yeah.
So that's also something that we're working through now as well.
So I want to go over a couple things. I mean, I love hearing macro people talk. I don't know how the audience feels about this, but for me, like I said, I'm just a simple trader. That's all. I look at it and I love listening to what you guys put out. I love reading the stuff that you guys put out, and just answering these questions and just going back to what happened back in those days to now. It's pretty interesting. And because we've kind of went back and talked about some of the things that have happened in the past compared to now, in your research, I'm curious. And I hate kind of doing this, but and part of me wants to do it because I feel like it's important. Um, is there ever been a time like this where you've seen uh, all these different things that you guys are talking about line up in history that we can compare to, or is this just something that's completely new? And like I said, I hate doing it because I think it's always new and different. But what time frame can we compare this to in the past from your guys' from your lens?
I don't think we can.
Yeah. I mean, this is there's analogs, but there's nothing that matches everything we're seeing here. Because
Yeah,
we can look at the '70s. We didn't have this kind of debt overhang then either. So there's just a kind of a different
exactly.
dynamic.
So the size of the balance sheet that Mayhem showed is like nothing, the US has ever seen. First of all, the last time we had, the last time we had, some semblance of QT, inflation was super low. So, he's right. I mean, there's nothing that actually matches anything in history. We can take bits and pieces of history,
Yeah.
but I don't think there's anything that exactly matches what's happening right now.
I love how both of you answered that because you didn't try and compare something that's not comparable to it. I think that's extremely important. It's one of the reasons why I'm a fan of both of your works. You just say it for what it is, and I think that that's what makes this stuff so important right now. Mayhem, I've seen you have a couple of other slides maybe that you wanted to show, and I actually have another question for you.
Sure.
We'll pop this up. So Jeff is saying, I know Mayhem isn't a big fan of crypto, but when the Fed eventually pivots, and we all know they will, whether it be 2023 or after,
Mm.
won't the easy money period return and send crypto back up?
Well, so one of the things about crypto is this idea of scarcity, right? But is it possible to have scarcity with over 19,000 different coins? So I
I
think
mean,
that's a question that we do need to ask about the sort of the how we value these things. The idea is this scarcity. There's really an abundance. There's too much supply. There's more supply every day. The other thing is, yeah, there's a strong positive correlation between the abundance of liquidity and low cost of capital and crypto performance. But how many of those 19,000 coins will survive this? I think that's the big question. I don't think it will be many of them. Now, the ones that do survive, if they can find some kind of practical utility that can scale, that's actually used in legitimate commerce or otherwise, maybe there's a future for those in an environment of where there's an abundance of liquidity again, sure. But from what price? From what bottom? Is it going to be Ethereum at $50, $500? I have no idea.
what I want to talk about next is actually this. I'm putting this title up for a banner, and not that one. This is something I see people compare all the time, and honestly, it drives me crazy. People are talking about the correlation between Bitcoin and the Nasdaq.
Yeah.
Okay, and for me, I look at it like this. Look at you. Just because a chart looks like another chart does not mean they're correlated. And I ask you guys with, I know some people say, well, that's what the definition of correlation is. But look at the percentage moves. I think Alpha Trends put out something. I look at crypto. I, I can't see how I could ever trade the Nasdaq or Bitcoin based upon what the other one is doing. I just
Sure.
feel like they're so different that it drives me crazy. I don't know what you guys think about comparing crypto to equities besides a chart that sometimes moves together.
So, oh, go ahead, Aisha.
Yeah, so I read a statistics somewhere and I can't remember where, but it said that people who are actually holding high beta stocks, 60% of the people who actually hold high beta stock also hold crypto. So I think that's possibly where some of your correlation comes from, that a large part of NASDAQ holders are actually Bitcoin holders as well. But Mayhem, you wanted to say something?
Yeah, so I mean, I think there's some similarities between Bitcoin, the Nasdaq, ARK, high yield corporate debt, treasuries. They all move the same way. There's been this sort of harmonized deleveraging across every single one of them. If you put them all up on the same chart, and I apologize, I don't have it available here, but it's very similar to that other duration chart I showed you, where it's just
Yeah.
everything's just moving in sequence. So I wouldn't trade them off of signals from each other per se, but I would just kind of take the macro lens view of this is deleveraging. This is people just getting out of positions. And if you're in a high growth stock that's not going to make money maybe ever, or if you're in a Bitcoin type of, or another kind of altcoin or whatever, and you have to get rid of exposure in your portfolio and you don't know what these things are worth, or maybe you start to have a moment of clarity and you realize maybe they're not worth anything, you're going to sell them. And those are the first things that are going to be sold. So I think that's one of the reasons that we also see that deleveraging going on in those assets.
When you're losing money, you go to the weakest hand you have first. That's
Yes,
the bottom line.
Yeah.
I
exactly.
mean, I've
Yeah.
owned so many different things at times where I'm just getting smoked in something else. I take off the one I have the least conviction in first. That's the
Exactly.
bottom line. I don't care what it is, and that's what creates the correlation. But I look at it and say, I remember people telling me when I was coming up in this industry, saying, gold is the greatest hedge against the Fed. Gold is a hedge against stock market. And every time, and you go back and look at 2008, I'll never forget it. Because until you've actually done it and see it, I'm buying a bunch of gold in 2008 when my portfolio is getting whacked, and I'm just getting killed even more.
Yeah.
I'm selling stocks. The next thing you know, I'm losing on both. I miss half the rally on the way up because I don't want to buy anything back. That's a whole other story. But it's like, I think it's so important, especially for traders or investors, if you're managing your portfolio, trade things for what they are. I mean, this is why we do a lot of the macro homework, because I want to see what's going on inside of these things. And both of you were talking about really what's happening a lot inside these markets, because that's to me where you can have a stronger hand versus just buying something because or selling something because the price action and something else is potentially dictating it. Hard to hold that. There's a couple of other things I want to talk. Well, actually there's a comment back here, Deer Point, because we had that discussion about. He said should specify Volcker point. Friedman pointed out that pretext to every rise in interest rates was increase in year-over-year volume of credit issuance. which was the basis of the interest rate fallacy. I don't know if you guys want to comment back on that.
I just disagree that there's any Volcker fallacy on any level.
Yeah, no, I just figured I'd bring it up. He's engaged. Um, let's see. This is I'll have to read this question on some of these. It's great. When I get the macro traders in here, some of these questions I don't even know where they put these symbols. I don't even know what they're talking about. For those with ISDA, not sure if Aisha or Mayhem has won, and a Bloomberg USS W210 looks attractive, which is a swap curve. I've never traded a swap curve, but it looks like that spread could widen, which looks attractive.
I know what an ISDA is. I don't know what a US is
I think he said this.
W210.
Yeah, I think that's what he's just talking about, the symbol. I know somebody
Um,
I
looking
so
at him
I
on the fly. I'm like, I don't know what that is.
I'm thinking it's maybe the 210s, the
Yeah,
spread
it's probably the
maybe.
210. That's probably what it is. Yeah, USSW2. That makes sense.
Um,
So he's looking
I
at the swap curve of 210. Yeah, I see what he's saying. Okay.
No,
yeah, I
the
don't.
210 is not a swap curve. But anyway,
It's not. Yeah, it's just a yield curve.
yeah.
Yeah, I have no opinion on that. I don't know
Well,
enough
let's
about
actually
that to make
talk
a
real quick.
comment.
What do you
Yeah,
think about? We didn't talk much about this at all. The yield curve in general.
sure.
I mean, I think we should talk about that because obviously that's a great, it's an important thing right now, and I'm actually looking to see what they are right now. And so you got the twos are at 2.82. You got the fives at 3.03. The fives and the tens are the same, and the 30s are the 3.14. What are your thoughts on the yield curve? Uh, we'll go with you, Aisha, first.
So I think we're just like seesawing between inversion and not inversion. So we invert one day and then we don't invert the other day. So I think a lot of people are now looking at the 3 month versus the 10 year, then they're looking at the 3 month versus the 30 year, and various other versions. But however you look at it, it's really flat. It will start to tip again. Um, what's this
I
now?
just
Is
pulled up.
this
Yeah,
like
I
the
got the.
three
This is
and
the two
is this
year.
the 2 and 10?
Yeah, this is the 2 year. I got the two up. I've got the five,
Okay.
the 10. Just pulling them up so people have a reference to see where they're at.
Okay, so basically, people are looking at the yield curve, whether it's going to predict a recession or it's not going to predict a recession. If it dips, it will. If it won't, I mean, it's just one of those things. It may or may not dip, but regardless, it's really flat, and we know what's going to happen. Short-term rates are going to go up, long-term rates are going to come down. Whether it inverts or not, we are going into a recession most likely. So it could either predict a recession or not, but doesn't matter.
I think that's the next topic, and it'll be the final one for today. Um, and we're going to talk about how imminent is a recession. We talked about so many different things today. I think from a personal standpoint, I always look at it. Like I said, I don't know the details that you guys know the data, but I don't need someone to tell me it's a bear market. If the S&P gets down 20% or more just from trading it, it feels like a bear market. And I just from talking to my friends and businesses and what I see, to me, it feels like a recession's pretty close. I mean, you guys know the data. What do you think?
Yeah, I mean, I think we are closer. We've had 1 quarter of negative GDP print already. We have some pretty weak econometrics coming in, and the yield curve flattening actually has an impact on banks because they're borrowing from the short end, leveraging up, and lending against the long end. And the flatter it is, the less they're going to be lending, and the more critical they will be of who they lend to. So that has a knock-on impact as well. So I agree. I think we are close to recession. I think it's more than likely that we have the start of a technical recession either this year or very early next year. And I think that the Fed is more than inclined to bring us into that. And look, the Fed also has a 6 to 18 month policy delay, where they make a change in how it effectuates the economy. So they almost always overshoot both ways.
Yep,
Aisha?
agreed. No, no, I agree. I think the Fed will tighten into a recession. They have no other choice. And I actually had a couple of slides which kind of points towards that direction. So if you want to quickly
Yeah,
pull
I'll
it
put
up,
them
and
up
I
right
can
now.
just quickly,
Yeah.
yeah, I can just quickly run through them. So a couple of things that we're looking at is housing. So we know the housing is in a bubble, and this bubble is going to pop. So once
I
this, yeah, it will. It just has to. It has to, right? So this is one signal. If you see that the red line's coming down, this means, demand's coming down significantly, and we'll see more of this as we go along. We see debt rising. So we have household debt rising and we have housing debt rising. So non-housing and housing debt. If you look at the figures, it's like 105% increase from 2004. And then you can see housing debt has increased 86%. So debt is up, interest rates are going up. We're all going to be in a lot of trouble. Um, and that leads to mortgages. So most people are now worrying about paying their mortgages, and it's not just a worry. What we're looking at, or what we're seeing rather, is that there are delays. If you look at the red line, which is going up, which means people are delaying their mortgages by 90 days, or up to 90 days, which is technically delinquent. If you look at the green line, which is whether mortgages are current, they're coming down. So this is again another sign that we're having stress in consumer credit. And then finally, what we're looking at is companies. So I know you've heard about what happened with Target lowering their margins yesterday. And then the big issue is the inventory glut and all of that. But I think the one thing that I want to sort of end on is the expectations. I think it's not just the analysts, but as well people on FinTwit and everywhere else. I think our expectations have been set too high. I think we really need to recognize that we need to bring these expectations down. We are going to go into a recession. We are going to have margin compression. And everything that we've seen over the last 2 years, fueled by cheap credit and ample liquidity, is going to go away.
And Anthony, if you could just flash over to one slide I have on my screen, because this is a perfect way to close what we're talking out about, because we're talking about liquidity, right? So liquidity in its abundance is strongly negatively correlated with volatility, which means that liquidity, when it is not abundant, is a driver of higher volatility. So I wanted to tack on to Aisha's point there that indeed, as the Feds drain liquidity from the sort of, insane amount that they added into the markets, because be real, during COVID, it was quite frankly an insane amount, both in size and velocity. It's the other way of that liquidity being drained out of the system certainly promotes volatility. And we already see that just in the markets trying to price in what the Fed's going to do before they've largely done it.
Yeah, I can't thank you guys enough. I got to tell you what, you guys have opened my eyes to a lot of new things, and I think they're very important. And like I said, I've been following you guys throughout the year, and you do just do an excellent job of explaining things. Like I said, right to the point, and that's what's just so important to me. As traders, we don't have time. I don't know what you guys know. I admit that. I'm good with that. I like to learn from other people. I like to see what's actually happening in the market behind the scenes. And like I said, I can't thank you guys both enough. If you could just tell everybody where they could find you on Twitter or maybe a website. Aisha, I know you got a Substack going. I'm excited for you about
I
that. Tell
do,
everybody where they can learn
yes.
more.
So my Substack is Aisha Substack.com, and of course my Twitter handle is Aisha Tariq, my full name. Yeah, that's it.
I will put both the links for those in the drop down below in the YouTube
Thank
following
you.
this. And then also, maybe if you guys want, I know Mayhem, we're going to get to you and where they can learn more about you too. But if you guys want to send me the slides, I could also put that on anthonycrudele.com for people to
Sure,
download. I think
absolutely.
that'd be great for people to follow along on audio. So Mayhem,
Sure.
I love your stuff. You and the
Thank you.
horse, been following you guys for a while. Where can they learn more about you?
Sure. Well, first I also wanted to say I really enjoyed the interview that Horace did with you on Trader Aid. I think you were a great guest. You provided all kinds of insight, so I've really enjoyed that one. So I just wanted to give you some props there. But yeah, people can find me on TraderAid.com. It is a throwback to Gatorade. We like to have a fun with the name, but we also are trying to provide a little bit of data and knowledge and otherwise to kind of quench people's thirst and appetites for markets, right? So Trader Aid's all about trying to help buy retail, gain more consistency, provide actionable trade ideas, but also really build a foundation to become a more consistent trader and investor. And then also I can be found on Twitter, Mayhem number 4 Markets, Mayhem 4 Markets.
I highly recommend you guys check out everything they're doing. Aisha, I'm so excited for you in the Substack. I will be reading it
Thank
for
you.
sure. And Mayhem, I'm already at Trader Aid, and I love what you guys are doing. And
Thank
thank
you.
you guys for educating us. It's like we said, it's a year that we've never seen. It's usually the case in these markets, but this is a special year, I think, in terms of something that we have not seen in the 20 plus years I've been doing this. It's been an interesting year to say the least. And
Well,
thank
we're
you,
making history, right?
Yeah,
Yes.
and you know what? And it's just going to be so important to follow macro traders like yourself to stay engaged in what's happening in these markets going forward, because we need to stay in tune with it. Thank you both again so much. I really
Thank you.
appreciate your time. I look
Thanks
forward
for
to
having
having
us on.
conversations with you in the future. Thank you.
That would be great.
Thank you.
Thanks again.
All right, traders, those of you that tuned in today, thank you so much for your comments and questions. It's always a blast hearing from you guys. That's a wrap for today. I will see you guys next week. See ya. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.